Okay, into the homeward stretch. So the first step we've got to do when we get a question like this, and you may get a full comprehensive question which does the whole kit and caboodle. It may be just looking at current tax, it may be looking at just the deferred tax, it may just be looking at elements of the deferred tax. Who knows? Depends what sort of mood I was in when I was writing the question. So the thing you've got to do with working out the current tax payable is you've got to figure out your taxable profit. And that is basically taking your accounting profit, which has had all these various accounting revenues and accounting expenses in there, and stripping out all of those things which work differently for tax purposes. So if you've got revenue which gets accounted, which is a revenue for accounting purposes and revenue for tax purposes, then you just leave it. You don't have to worry about it. But if you've got a revenue which is included in accounting but doesn't get included in tax, you've got to strip that out. If you have an expense which is an accounting expense, like you have a parking ticket and that has reduced your profit, but then you don't get the tax deduction for it, you need to basically add that expense back in because that will have lowered your profit. So you add it back in and then you don't do anything else because you don't get the tax deduction for it. So you have these, in essence, you're pulling out all the accounting effects and you're adding in all the tax effects. And once you've done all of that, and once you've got your taxable income, you just simply multiply that by the tax rate. That gives you how much money you owe the government. Debit tax expense, credit income tax liability, or credit current income tax liability, or credit current tax liability, whatever you want to call it. You get that, and that is the first step done. So let's have a look at it. Okay, I've just stripped out the information from here. I mean, yes, it does work. It's probably not the best way to do it. I just wanted to show up how that would look if you were doing it from a tax point of view. But you've got this set of information, which is your, all your accounting profit down, all your accounting effects that will give you your net profit before tax. And so your net profit before tax, the starting point, is $435,000. Now, we take this section. We then have a look at the other information that we have. And what we have is all administration and salary expenses incurred have been paid at the end of the year. None of the LSL expense has actually been paid and it's not deductible until it is paid. Warranty expenses accrued. You've actually paid out 10 grand in warranty costs, so obviously your product has had some problems. Insurance was initially prepaid to the amount of $40,000. Actual amounts paid are allowed as a tax deduction. Amounts received from sales, including those on credit terms, are taxed at the time the sale is made. The plant is depreciated over 5 years for accounting purposes, but 4 years for tax purposes, and you have a 30% tax rate. So we have all that information. You wouldn't get this sort of setup. You'd have to actually really start this from scratch. So I'll just talk about what we've done here. So we've started with net profit before tax. What we want to end up with is assessable income, which is this number down here. Obviously, we need to work out how we get there. These ones are at the top. These are the accounting effects, which we've got to strip out. And in this case, they're all expenses, so we're just adding them all back in. But you may well see revenue effects as well. In this case, we have all the tax effects. Now, before we get to actually looking at the numbers themselves, just 2 points I want to highlight, which is the first is if you have an item coming in one of the places, make sure you pair it up. So if we've got something dealing with expenses up here, make sure something dealing with the long service leave, you have long service leave. You've got warranties, depreciation, insurance. Make sure you pair them up. That way you won't leave one hanging. even if it has a zero effect, it just makes it less likely that you're going to make a mistake with it. Just pair it up and you'll see that the two effects. The second thing is, look, it's not like if you don't do that, you're going to be wrong. It just makes it more likely that you're not going to get lost along the way. And the second is much the same. I wouldn't net them out. I wouldn't go, okay, well, let's look at warranties. Warranties, we're adding back in 45, but we're taking away 10. So I wouldn't just go, the net effect on warranties is adding back in 35. Because again, look, it's the right answer, but it's just more likely that little errors will creep in. If you're in an exam, you might get lost with where you're at. It's harder for us to necessarily figure out what's going on if you haven't got the right number. It's just easier for us to track through what's happened. It's less likely you'll make mistakes. Just everybody's happy. Let's have a look at where the numbers come from. In the first bit, these numbers, if you have a look at them, all come from the expense items listed. Long service leave, warranties, depreciation, insurance. So these 4 items, which do get done differently, we've all included. These ones get done the same. They said they got all paid and they've all been dealt with, so you get the tax deduction, you've had the accounting expense, there's nothing we need to worry about. So they're all sweet. So we've added these in. Now we've got to look at why we've deducted these particular amounts. For long service leave, for warranties, and for insurance, the simple fact is that we've paid them. We've paid nothing for long service leave, so we don't get a deduction. We've paid $10,000 for warranties during that course of that year. That's what we get as a deduction. For insurance, we prepaid $40,000, and that's why we get the deduction there. I mean, you're never going to pay insurance after the fact. Sort of defeats the purpose a bit. But we've paid for that, and that's when you get the deduction. So we add back in all those profit effects, so the expenses. We take away all the tax effects, which are those various tax deductions, and what we end up with is an assessable income of $465,000. Multiply that by 30%. That gives you your 139,500. And then that gives you your debit tax expense, 139,500, and your credit income tax payable of 139,500. That is the amount of money that you owe the government. And if you were just doing the tax payable method, that's where you stop. We're not doing the tax payable method, so we've got to keep going, but that's where you stop. You just go, that's the money I owe the government, bang, that's your tax expense, move on. If you're looking, I'm not going to flip back to the slides, but the next slide is step 2. Actually, step 2 and step 3 run together, which are recognize the effects of the temporary differences. So we're picking up any sort of deferred tax asset effects or deferred tax liability effects. And to do that, we need to go and look at the tax base of the assets as compared to the carrying value. So the information we have in this case we've got cash, inventory, accounts receivable, prepaid insurance, and plant, which nets out at 480. We've got accounts payable, 2 provisions, and a loan payable. So we've got these accounts here. We don't know the tax base, and we don't know the temporary difference. Some things you'll get used to. Cash and inventory. I think they said something about the sales are taxed at the time the sale is made. Doesn't matter about receipt, so we deal them in there. The only issue with accounts receivable is if you have an allowance for doubtful debts. If you do, you need to look at what happens with that allowance. But the actual account receivable account assuming the sales are taxed at the time the sale is made, will look like that. Prepaid insurance, what we're looking at is the amount that is going to be deductible, and the insurance, you paid $40,000 for it. That $40,000 you've already got as a deduction. So of that $40,000 that you paid, and I'll just push it down here. So you paid an amount, and you've used 35, so you're left with 5,000. Now that 5,000 is the amount that you see up here, but you've actually already got the deduction for that full $40,000. So even though you've got a $5,000 asset sitting there, you get no deductions based on you using that because the deduction already happened. It happened when you paid for it. So the tax base for a prepaid insurance is 0, and we end up with a $5,000 temporary difference. We don't know if that's a DTA or DTL at this point. You can probably hazard a guess, but we have a $5,000 temporary difference. Planned at cost is going to be the same. The net is really what we're trying to work out, and that's going to be affected by depreciation. It's a similar sort of a thing. We've paid $600,000 for this asset. That means over the lifespan of this asset, however long it's going to be, we're going to get $600,000 worth of deductions. So at time 0, the tax base would be $600,000. At time 0, the plant net would be $600,000 as well, so there'd be no temporary difference. But we're now, at this point in time, we have already had deductions of 150, which means we've got $450,000 of deductions left to make. So the accumulated depreciation, or you can think about it, the accumulated tax depreciation, is $150,000, gives us $450,000 of future tax deductions to make in relation to this asset. Let's just do it on the net basis, and that is a $30,000 temporary difference that we have. Accounts, the payables that we've seen there, $300. The ones that we're interested in, because I mean we discussed those payables. What we did. Actually, that was the $300,000 Christina lent me. Thank you. Provision for warranty and provision for long service leave. So it's the carrying amount less the amount that's going to be deductible, because these aren't unearned service revenue. So it's the carrying amount less what's going to be deductible in the future. For both the provision for warranty and the provision for long service leave, that 35 and that 30 picks up that we expect to get $35,000 and $30,000 of deductions in the future, which means it's 35,000 minus 35,000, the tax base is 0. It's 30,000 minus 30,000, the tax base is 0. The temporary difference then becomes 335,000, temporary difference 30,000, and we put in the tax bases, we put in the temporary differences. So we put in the tax bases, we put in the temporary differences. We now need to figure out, are these DTAs or DTLs, or what these would lead to. And let's have a look at the difference. In this case, prepaid is greater than the tax base. In this case, the carrying value is greater than the tax base. In this case, the carrying value is greater than the tax base and greater than the tax base. So what we have is a situation, and it's easy to just work from, as I mentioned before, work from the liabilities. We know these give rise to DTAs. And that means because the signs are the same way, and because these are assets and these are liabilities, these have to be the opposite, or will lead to the opposite effect. So these will give rise to DTLs. Combined, that'd be $35,000 times by 30%. this would be $65,000 combined times by 30%. So we've just summed these two effects. That'll lead to 65,000. We've summed these two because they're both going to give rise to DTLs. That leads to 35,000. If you flip over the page, that ends up with the bottom entry that you see there, which is 65,000 times 30%, and that's 35,000 times by 30%. The difference is going to be a tax expense, and that is a balancing item there. So whatever you've been left over with is the credit, in this case, a credit income tax expense. You could quite happily do these as separate entries. You could do them as debit DTA 19,500, credit tax expense 19,500, debit DTL, debit tax expense 10,500, credit deferred tax liability 10,500 if you really wanted to. So we've recognized all of that.